So what is the ORB strategy and why does it work so well as an entry model? Well, that is a question I hope to answer by breaking it down into palatable parts. So here's the breakdown on what I will cover. I'll first define what the ORB and IOF actually mean. These are important definitions if you want to be successful in this strategy. Number 2, how to set the trade up by leveraging the range of the first 5-minute candle. And number 3, what criteria or conditions need to be present in order for optimal entry, meaning how do I enter this trade and actually make profit without getting wrecked. In order for me to get you guys to understand why this trade works so well, I need to first clear up by giving you guys some definitions to provide you guys with a little bit of context. So institutional order flow, or IOF, refers to the tracking and analysis of buy and sell orders placed by large financial institutions such as central banks, hedge funds, and commercial banks. It represents the footprints of big players focusing on how to fill massive positions using liquidity zones, accumulation, distribution, and price manipulation to move the market. In essence, we're trying to ride the big waves that the big boys in the institutions are providing to us. Now, as far as the ORB definition goes, the opening range breakout, or ORB strategy, is a trading method that identifies a price range, high and low, established on the first 5 to 15 minutes of the market session. Traders buy if price breaks above the high or sell if it breaks below the low, aiming to capture early high volume and momentum provided by the institutions. So in other words, we're trying to make big moves which provide us big profits by capitalizing on institutional order flow. Now that we have a clear understanding as to why it's important to trade with the institutions to maximize our profitability, then the next thing is what do we choose to trade, right? We need to trade institutional grade assets, which include, some of the big boys like the S&P and the NQ and all that, but I focus on crypto. And so which crypto assets have institutional trading involved, right? So of course there's Bitcoin, right? We have the ETF on Bitcoin. We also had one on Ethereum, right? Both of these are institutional grade assets. Now, doesn't mean that you can't trade a lot of the other, I would say, top 20 coins, because if you look at the charts right now, you will notice that most of them look almost identical, guys. Look, I'm just going through them and you can see there's not much difference in the chart patterns. And I believe that is because most of the top 20 or so mimic the movements of Bitcoin because there's algorithms programmed on the exchanges. It's very botted. There's a lot of conspiracies, but the fact that they all look very similar leads me to believe that a lot of this stuff is botted or has algorithms attached to it and mostly follow the movements of Bitcoin. So I don't really mess around too much. I just trade Bitcoin. You can pick whatever asset you want, but I like to trade Bitcoin because it has a lot more volume than a lot of these other coins do currently. So with all that being said, this is how we're going to set this trade up. So the first thing you're going to do is you're going to go to the 5-minute time frame, which is already set up at the moment, and then you're going to look for the opening. So you have 3 separate choices, and depending on where you live, you might want to choose accordingly. Now, in order to set this up properly, you're going to want to switch over to the UTC-4, which is the New York or Eastern Standard Time if you're here in the United States. I really don't know how to set it up any other than the way that I learned. So if you want to, click the bottom right hand corner to pull that up in order to select. So once you have select that, you have 3 options depending on where you're at in the world. You can trade the New York session, which starts at 9:30 EST, London 3 p.m. EST, or Asia 7 p.m. EST. All 3 of them I've tested, and this strategy actually works with all 3. Now for this example, I'm going to use the New York session. As you can see at the bottom of my screen, it is 9:30 EST, and I am on the 5-minute time frame, and I'm going to isolate this first 5-minute candle by drawing a box around it, just like so. And this box is going to help me determine which way I'm going to enter this particular trade. But this is the really tricky part that most people have a hard time with. And so I'm going to break this down into very minute details. Now that we have that first 5-minute candle isolated, you want to look for next is a break above or a break below price action. Now, once that first 5-minute candle prints, you're waiting for the second one to print. just like so, that little guy right there. At this point, you want to go to the 1 minute time frame to manage the rest of the trade. Now, this is where things can get kind of tricky because you're looking for 3 separate conditions. One could be a trend line retest, it could be a fair value gap retest, or a combination of the both. And I'm going to show you examples of all 3, but let's just follow through with this example just to see what it actually looks like in real time. So if you look very closely at this one is tough to tell, but if you look specifically at this candle, you'll see that this candle closed above this line. So you have a candle closure above the line that it broke. Okay, so that's step 1. And then we need a retest of that line or a fair value gap or a combination of the both. And here you can see that for a split second, and you didn't even see it because the replay doesn't offer it, but it did come down and it did tap that line ever so slightly. Once it tapped that line, you could see the rest was history when you're talking about the rest of this trade, right? So this trade, I did take it this morning. It did give me a 3-to-1 risk to reward. So this is a decent trade, right? So we got the break, we got the retest, and we got the big move, right? So this was clean, right? This doesn't necessarily happen every single time. And I want to show you all the various ways that this trade can be entered and some of the pitfalls that you need to avoid in order to do this consistently and be profitable. Now, just to provide a little bit more context, here's a couple more examples of a trendline only retest where you can see how price broke above, closed above, came back down, retested. Even though it broke in a little bit, it did not close below this line, kind of making it a protected border. And then you can see what happens right after, right? Here's another example, both on Solana, by the way, where price broke out, came back, retested once, twice, 3 times, went out again, retested 2 or 3 more times, and then it did its thing. But you could tell that this is a border that's being protected. So most likely this is the direction that the institutions wanted to push price action, right? Now, one of the other ways to enter this trade is to enter it with the fair value gap only. So often when the price takes off and breaks one of the 5-minute candle ranges, one of the zones, it will leave a long candle, which gives you an idea that price is being pushed by the big institutions if you do see these big candles. And what they will leave behind is a fair value gap. And if you don't know what a fair value gap is, then go check out the videos that I've created just on this subject alone. But if you don't know, it is essentially whenever you have a large candle, you're going to have a preceding candle, right? This little guy right here, and then one that goes afterwards. If this candle and the third candle do not intersect and leave a gap in between, that is a fair value gap. So this is another entry for this particular model, right? Because if it doesn't come all the way back to retest the trend line, it will come back to retest and fill a gap very often. And you can also enter this particular strategy on a fair value gap, right? And here's another example of very similar move where price broke to the downside, but did not come all the way back to retest the line, but did fill the gap that it left behind before it essentially dumped. And the third and final way I'd recommend to enter this trade is when you have a fair value gap present and a trendline retest. So you can see here this long candle, it broke through the upside and it created this huge gap denoted by this rectangle. Then right here, you can see how the candle came into the fair value gap plus touched the trend line. So you have a fair value gap plus trend line retest before price ends up taking off. And just for extra credit, here is another example here where we got that fair value gap with this rectangle here, and the range of the first 5-minute candle is there. Price broke out here, but it left this huge gap, right? This big candle gap that eventually got retested along with the trend line, right? And then it took off and went to the downside. So that's another fair value gap trend line example. And by the way, which is what I think is the highest converting combination when you have the both of them. So I would always look out for a trend line retest first, but if you have a fair value gap there, then that is extra confirmation that the trade is most likely heading in the direction you are looking for. Okay, now that we have described all the entry models and all the various ways that you can get into this trade, I want to talk about what is arguably the most important part of this whole video, which is how to avoid manipulation, because manipulation happens quite often, and manipulation is essentially, if you don't know, it's a fake out, right? So it faked one way, but the real big move was the other direction. So how do you know which is when they're faking you out as opposed to whether it's the big move. Well, outside of the criteria that I mentioned earlier on how to enter this model, you can see that it did come in retest and then it fanned out. So I guess you could count that as a move, but you don't want little moves, right? You're looking for the big profitable expansions in your trading. And just so you guys know, if you guys haven't seen that video, right, if we go look at the Asia session and we look under manipulation, you will see that it happens 72% of the time. They're gonna fake one way and go the other. I mean, it happens quite often in the Asia session. Let's look at the New York session. How often does it happen? 69% of the time it is going to manipulate. So guys, if you haven't seen that video, go check it out. I have a couple of videos on the topic of how often price manipulates. So where's the London? Anyways, guys, take my word for it. The London one, I don't think it manipulates as much. I believe it's like 47.50, something like that. So go check out that video if you're interested in more details about the manipulations. Now that we know that most of the time we're going to manipulate before we head in the correct direction, how do I know if it's a manipulation or not? Well, you can always use other confluences, right? For me, I like to use the RSI. RSI is a good indicator to let you know whether we are getting close to a bottom or a top. If price breaks down and breaks out a certain direction, and in this case we broke out to the downside, right? How much more room on the 5 minute specifically? I like the 5 minute because it plays a big role in this trade, in this strategy, so we're using it quite often. Now, nothing is 100% for sure, right? As far as using indicators and using them to help you to determine how far a move is going to go or not, but the RSI does a pretty good job in my opinion to let you know, like, there's not that much more room here on the 5 minutes. So most likely this is the extent of this move, and if the move is about the same size as the range, right, the 5 minute range, then we only have like a 1-to-1. So anything under 2 risk to reward is just not probably the move, right? You want something that's 5-6 times the size of the range. Here's another example to the upside, right? So I just want to show that this happens on both sides of the range, right? So you might have had some fake out, I guess, down here, but again, when something breaks and closes above the range, you would think that it's going to go in that direction, especially because you had several attempts here to break, but the trend line held, right? So it came back and retested, and then it did this, and you're like, oh man, maybe we're going this direction. Well, look at the RSI. We peaked out, right? Not that the RSI can go into this territory, but more often than not, once you have hit this above this 70 on the RSI, or the 30 if you're looking to the downside, then most likely you have reached as far as the price action is going to go before it pulls back. I think the RSI is one of the better ones. You can also use something like the MACD, right? Because as soon as you have a crossover of the MACD lines here, most likely you got this break where now we're on the bottom of the 0 line, right, of the median, and you can tell once this crosses here, most likely it's not going to uncross for a long time, and you'll see that the real move was to the downside. So there's many ways to really help you find confluence. And if you don't know what confluence means, it just means something else to help you justify your reasoning. This is a good example of how the RSI can benefit you, right, in this trade and give you a semblance of how much room you think price is going to go, and to ultimately be able to figure out whether there's a manipulation or not. So where do we put our stop loss? Well, this is pretty easy. You're going to put it on the opposite side that you enter on the 5 minute candle range. So 5 minute candle range is here. If you enter to go short, you enter to the downside, then what you're going to do is you can put your stop loss on the opposite end. Same thing if it's the other way around. If you enter on the bullish side and we're going this way, then you're going to put your stop loss on the opposite side of the 5 minute candle range, and you will be safe about 75% of the time. You will not get your stop loss triggered once price has determined which direction it wants to go. Last but not least is how to use the risk reward tool, which is essential to measure how much you're going to make on any particular trade. And in order to use this thing, you got to come over to the left hand column on any trading platform, including TradingView, and you're going to go to not this set of 5 lines. You're going to go to the second set, which is underneath it. You're going to select short position if price is going down and long position if it's going up. So in this case, price is going down, so I'm going to select the short position. And then the next thing I'm going to do is I'm going to click exactly where we normally enter, which would be right here, because we're going short. We're going to enter on the break of this part of the 5-minute candle range. So you're going to click here, and then you're going to take the top portion and make sure it is the exact range of the 5-minute candle, because this is what we're risking. And this is what equals 1 on the risk to reward. The next thing you're going to do is you're going to extend, and you're going to extend it to however long you think that you want to hold. Since the data tells us that most of the time we're going to hit 3 to 4 risk to reward on the New York session, and on the London session we're at least getting 3R, right? Because all of this counts as 3R plus, right? And same thing with the Asia session, right? We're getting at least 3 to 4R, right? With all of these, right? All of this counts as at least 3 to 4R. Then you can safely determine that maybe 3 is probably the best, most proven to be a risk that we want to take. Then you can safely determine that 3R is something that we're going to aim for each and every single time. That is what I've done, and I win most of the time if I do choose this as the risk to reward before price comes back and hits my stop loss. The way that you could read this, and in this particular move, we got what you could see here as a 4.6, right? So we got 4.6 times this amount. So 4 times our risk to reward, right? So this is the reward is the 4.6, and this is the risk 1. So risk to reward is determined by using this tool, and it's the best way to manage your risk by knowing that you're always going to be risking less than what you're going to be making. So that is how you determine by back data to show you exactly, at least in the month of March and April, that 3R is a safe distance to aim for. So guys, I hope you got something off of this. I hope I cleared up any questions that you may have had about this particular strategy. And if I didn't, please ask the question and I will do a video responding to it just like I did to this one. Luke had asked a question to clear up some of the entries and some of the stuff that was confusing. So I hope by covering each and every aspect of this trade that you have a little bit more clarity on how to enter and exit. So I hope you guys share this. I hope you're subscribed. I hope you're liking my videos because it really does help me with this channel. So either way, guys, I hope you enjoy the rest of your day. Take care.